so much for joining us today. We really appreciate it. We welcome those who are here in person with us. It's always great to be in person with people. And then also we welcome all of you who are participating with us online. We'll go through a few housekeeping items here today before we dive in. Oh, where did my housekeeping slide go? Sorry. Okay, I will go over a few housekeeping items while you all get to listen. Throughout the presentation, feel free to ask questions, but if you will enter those in the chat, we will try and respond to questions throughout if we have time. If we don't have time to get to all your questions, we will circulate responses after the webinar is done if we can't get to all of your questions just due to time limitations. The slide deck will be available to all after the meeting, to all the attendees, and we will record the presentation. It is being recorded, and we'll post that on our website so that you can go back and view parts of it if needed. We are offering CPE today for both those in person and those online. Important note for those who are participating online, we will have attendance checks. We're required to do that. So we made some really hard questions for you to answer. Just kidding. They're not going to be hard questions at all, but when you we'll let you know to expect a poll, and then the poll will pop up on your screen. One thing to note is you need to disable any pop-up blockers in your browser window that you're viewing the Zoom webinar through. If those pop-up blockers are enabled, it will block that pop-up window for those participation poll checks. So take a minute right now. Those of you who are participating online, if you haven't done so already, make sure you disable any pop-up blockers in the browser window that you're using.
Okay. So the chat feature is currently disabled. If they have a question, they can use the Q&A.
Okay, sorry, Q&A. Thank you. So the chat feature is disabled. If you have a question, submit it through Q&A. Also, if by chance you're not seeing the poll participation check pop up, you can submit your response to that participation check into the Q&A feature as well. Sometimes we've had issues, or if you are having issues, you can submit your poll participation check response into the Q&A feature. So use the Q&A feature for questions, and if you need to enter your participation check answer, use the Q&A feature. And our little disclaimer here, we are presenting this information as everything stands today. And as always, we know with the fast evolving regulations and standards, information we present today is subject to change. All right, with that, we are going to dive in to what we are going to talk about in this first portion of our training today. We're going to talk about the new current expected credit loss standard, or CECL, as we'll probably call it throughout the rest of this presentation. And then the second section, just so you all are aware, we are going to have a great tax provision training from some awesome people in our tax department. So we'll go ahead and dive in. So what we want to look at today with CECL, we want to talk about the effective dates. So we want to talk about when, how much time do we got left? The clock's ticking. Then we'll talk about what assets are in scope for this new standard. We'll learn about some of the major changes that this will bring to the accounting for those assets that are in scope. We'll talk about some of the new disclosure requirements. And then we'll just talk about some best practices and some tips on how best to prepare for implementing CECL. Okay, so our effective date. So for public companies, those people have already gone through the pain of implementing CECL. So that was for the calendar year 2020 that public companies had to implement the new standard. So for everybody else, for the private companies and others, it's fiscal years beginning after December 15, 2022. So the clock officially starts ticking you're a calendar year entity on January 1, 2023. And just as a side note, if you do prepare and present interim GAAP financial statements, it does need to be implemented for any interim financial statements that you prepare. So just make note of that. It does apply to interim periods in 2023 as well. Okay, start a little bit high level, general impact and some of the whys. So the industry has always delayed recognition of impairment losses until there was a recognizable event. Sorry, I'm just going to minimize this. Thanks. Okay. So now this new model is based on expected losses rather than incurred losses. Some of the other impacts of that include there's now a decreased number of credit impairment models. I know that was one of the drivers for change here, because there are so many different models and methodologies, and this has kind of narrowed that. It eliminates the barrier for time recognition and adds a requirement to recognize an allowance of lifetime expected credit losses. And lastly, it does not prescribe a specific method for entities to use. So it's much more principles-based than we're used to on these loss recognition standards. So, okay, so let's talk about what assets are in scope. So any asset that is being booked at amortized cost basis, your held to maturity debt securities, financial assets such as your trade receivables, lease receivables, contract assets, and et cetera. Any financing receivables, loans that are with unrelated parties, loan commitments, free-standing contracts, any line of credit arrangements, and standby letters of credit. Okay, so those are our the main categories of assets that are in scope. So let's talk about what's not in scope here. So if you have financial assets that are measured at fair value, you're available for sale debt securities, but we love this. This is the funnest part, that they are out of scope of this standard, but they did modify how you are accounting for your available for sale debt securities. So stay tuned. Allison Johnson's going to talk about the available for sale debt securities impact in the second portion of this part of the training. So next, loans made to participants by defined contribution employee benefit plans are not in scope. Policy loan receivables of an insurance entity are not in scope. Promises to give or pledges receivable of a not-for-profit entity. Loans and receivables between entities under common control, and receivables arising from operating leases accounted for in accordance with FASB ASC 842. So that'd be on the lessor side of the lease. Okay, so talking a little bit about the kind of fundamental differences between how we've been doing it and how we will be. So under the incurred losses model, that we're recognizing a loss when an event occurred, like a bankruptcy, overdue balances, et cetera. And then the company would then write off the related balances once they knew it was for sure not going to be collectible. Now, under the new model, you're looking at expected losses. So an entity will recognize an estimate of expected credit losses for financial assets as of the end of the reporting period. And this is established using a contra asset allowance account. So I don't know if you guys remember back in the day when you were learning about a contra asset account, but it was always one of my favorite accounts. So now we get to use another one. Okay, this is just a visual depiction of what I was just talking about. On that last side, it's showing historically what we've done. We didn't recognize anything until there was an event. And now under the new CECL standard, you're recognizing it right at the beginning, for the whole expected life of that asset. You're recognizing basically an allowance for any losses. All right, here's our quick polling question number 1. We're going to pop that up for a participation check here. We'll give it a minute. So anybody who, I can't imagine you already fell asleep, right? But give it another minute. Guess I can just close. All right. Good on that.
Give it 2 more seconds.
All right.
1, 2.
Okay.
Can you show the results?
No. Oh, my pleasure. They want to work at Chick-fil-A. I love it. Cool. Okay, thank you. All right. Okay, important note here. CECL is expected to be applied to all in-scope assets. I know as I've been able to talk to my clients that I know this is going to have an impact on, they're saying, but our portfolio is really low risk. We're always really conservative. And the standard specifically addresses that scenario. It says that even if it's low risk, you're still required to calculate a current expected credit loss reserve. So let's talk through a little bit of an example here on held to maturity debt securities. So I'll just run through this real quick. Here to Winco has a portfolio of AAA rated corporate bonds. All bonds within the portfolio are classified as held to maturity. The investment manager indicates here to Winco has a pristine record when selecting AAA rated corporate bonds for investments. The company has yet to write off any contractual cash flows on the portfolio of bonds in question since he assumed his role 10 years earlier. So what do we think? Would CECL allowance be required for the portfolio? Anybody in the room here with me brave enough to say what you think? That's, yeah, they have to, right? Hey, under the CECL model, even if your risk loss is remote, an estimate of credit losses must still be recognized. So entities will need to measure expected credit losses on assets that have a low risk of loss, which would be essentially investment grade held to maturity debt securities. There is a narrow exception under ASC 326-20 that instruments with a zero risk of credit loss, but that's generally understood to be applicable to US government securities. That's the only thing that we've really seen there, is that it was meant to be very narrow in scope on that exception. Okay, so let's talk about the method for establishing a reserve. As we mentioned before, the FASB has not prescribed any specific method that you have to use, that you're required to use. So what the ASU does say, they define it as practical and relevant methods. So you may use different methods for different types of financial assets, depending on the entity's ability to predict the timing of cash flows and other information available to the entity. So our favorite answer is, it depends, right? So let's take a look at some models that are utilized. And some of these might be the same as some of the approaches that were being used under the old standard. The main difference here is that you can choose, and it can be all the way to, like I say, different types of asset classes, or it can even be based on what information do you actually have to use. So you've got your measurement approach. The first one, and maybe the most common, will be your discounted cash flows. So that one's pretty straightforward. Also, another method that you might see utilized is the roll rate. And that's where expected credit losses are determined by applying an estimated loss rate to the asset's amortized cost basis. And then you've got the loss rate method, where you're looking at expected credit losses, and they're determined by using historical trends in credit quality indicators. Another word for that might be delinquency risk ratings on that one. Your probability of default, your expected credit losses determined by multiplying the probability of default and by the loss of the given default. And then lastly, your aging schedule. And this one's pretty straightforward also. When you're looking at how long a receivable has been outstanding, and this method's commonly used to estimate the allowance for bad debts and on trade receivables. So you might be asking here, okay, well, how do I make that determination? How do I know? And in our opinion, we feel like your investment brokers or your investment advisors could help you look at your portfolio. It's going to need to be really individualized to what each entity's investment and asset portfolio actually looks like. So we feel like your broker or your investment reporting service provider could help you to see what inputs do you have and what methods make the most sense for your individual assets that you're looking at that. And especially on those three, the middle three, that you're going to need to have someone maybe help you look at what data you do have available for the different classes of assets there. Okay, so then the CECL initial measurement, let's talk about that for a minute. So as I mentioned, you need to use a contra asset, which is an allowance valuation account that's deducted from the amortized cost basis of the financial assets to present the net amount expected to be collected. At the reporting date, you need to record an allowance for credit losses on financial assets, and that gets reported in net income as a credit loss expense, and the amount necessary to adjust the allowance for credit losses for management's current estimate of expected credit losses on financial assets. So changes in the estimate occurs through the P&L in the period those estimates are updated. So with that, so your pillars of expected credit loss, if you read through the standard, they'll talk about these pillars quite often. And so these are essentially, these are your inputs. You've got your assets there, at the bottom of the structure. And then you're looking at some of your different inputs. And one of the first things to look at is, can I pool these assets based on risk characteristics and other attributes, which is a good thing about this standard. It does not have to be applied at the individual asset level. You can pool things that have common risk characteristics, and that is helpful in minimizing some of the administrative burden of implementing the standard. So look at what you can pool together, and then you're looking at contractual terms, you're looking at other qualitative and quantitative factors, and the historical loss experience for your specific entity and the type of asset, and then reasonable and supportable forecasts. So we just want to emphasize, before I talk about this next item, just emphasize, maybe I'll just go back to this slide real quick, that again, we didn't put in a whole bunch of different detailed examples here because it is so unique, it's so individualized, and there's no one right way to do it. So obviously, if you have questions, we're here to help you with that, but you'd need to sit down and do an analysis of your asset portfolio, and that's really where it needs to start. So with that, like I say, it's going to be uniquely applied and to each entity and what those assets really look like. One thing, the Federal Reserve provided a free tool to help. The tool is really meant for financial institutions with a lot of loans, banks and credit unions with loans. But if your entity does hold a large number of non-related party loans, mortgage loans, for example, some of our insurance clients utilize those as an investment vehicle. This valuation tool may make sense to use. And this is just the website link there to access that free tool that the Federal Reserve has provided. So with that, we're going to do our next polling question for our participation check. We'll give you all a minute to check in and respond. We'll see if people still want to work at Chick-fil-A or being really polite today. I love it.
5 more seconds.
All right. Poll is closed. Okay, let's see here. We might have a few minutes for a couple questions. Did we have questions come in on through the Q&A?
No.
Okay. All right, with that, we are going to move on to the next section of the presentation, and Allison Johnson is going to help us with that. To advance, sorry.
I feel a little bit like the bearer of bad news, and that you may have sat through that part and you're like, awesome, this is not going to be a big deal. And then, at least if we started looking at our clients, what I'm going to talk through is probably the piece that will be a little bit bigger deal. So as you can see, even though it wasn't specifically part of the CECL model, they did ASC 326-30 is the new reference, or the reference you can look to for the new guidance on available for sale securities, or available for sale debt securities. So a couple of differences. For your available for sale debt securities, this does have to be looked at each individual holding. So as Diane just mentioned, with CECL, you can kind of group like assets. That is not the case for your available for sale debt securities. You have to evaluate the expected credit losses. If you're purchasing a financial asset with credit deterioration, you have to evaluate that. You do have to evaluate this each period. So similar to CECL, you know, if you're going to be reporting interim GAAP financial statements, you should probably evaluate at those periods, but generally if it's just annual, that's also acceptable. So the biggest piece is this last bullet point of that historical change when you've marked something to market. You now have to evaluate whether that change is, if it's impaired, I should clarify, if it's impaired, you have to clarify whether that's due to credit risk or interest risk. And as you can see here, the treatment is different, that if it's credit related, it runs through the income statement. If it's interest related risk, it continues to be recorded in other comprehensive income. So similar to CECL, the idea that we're no longer waiting for a loss to be incurred before recognizing anything, that comes over here as well. And so you'll see that as we go through that, that's why you're evaluating it every time, every reporting period. And some of that is likely running through the income statement. So to just make sure we're all on the same page to start with, we're going to go back to maybe basic accounting of how we're currently accounting for available for sale debt securities. So in this example, we have a bond that's treated as available for sale. We purchased it for $4 million, par is $5 million, pays 10% interest. At the end of year one, the investment, your fair value is $4.2 million, and the tax rate is 25%. So if we were to go through what the initial entries would be for this, obviously our initial purchase would be cash out and debiting the asset. Your interest entries, you would record the cash in for the year as well as your interest income. And then when we look at the unrealized increase in value, you would debit probably a change in market value account. And then it would go into other comprehensive income as net of taxes, which is the $50,000. The good news is that's the last time we're going to account for taxes today. The rest of our examples, we're setting that aside just to help keep it a little more straightforward. So again, some of these items we already mentioned, but looking at the available for sale treatment versus CECL, when you're looking at available for sale, impairment is triggered when the fair value is less than the current carrying value. As we noted, we'll look at how we're going to break that out between credit related risk versus interest related risk. A key reason why there was separate guidance outside of CECL is that available for sale securities, you're already marking to the fair value. Whereas with the CECL related items, those were typically held at cost. So that's why there were kind of two separate pieces of guidance to help make the necessary changes, and why you'll see a little bit different treatment for these. So this is a model. If I could give you like one slide to pay attention to out of today, this would be it. Hopefully you'll pay attention to more, But this is a great tool to, at least for conceptually understanding kind of what we're talking through. So we'll walk through this and then we'll walk through it with an example as well. So the first question you're going to ask when you're evaluating is your investment holding impaired? Like I've said before, that's maybe the simple question of, is the fair value less than your current carrying value? So you can see on the chart, if the answer is no, that's great, you're done. You write it, record the increase in fair value, and it runs through other comprehensive income. On the flip side, if it is impaired, so the fair value is below, you have to ask kind of two questions, which you'll see them paired there. Is the first is, are you intending to sell that security? And the second part is, maybe you're not intending to, but is it looking like, based on maybe your financial situation, you may be required to sell that holding before recovery? If the answer to one, if to those is yes, that you think you might have to sell it, then that full impairment amount runs through the income statement. So you write it down. So that's consistent with what historically we might have called OTTI, other than temporary impairment. That terminology kind of disappears with this change. But like I said, if it is impaired and you're likely going to have to liquidate it, you write it down. So let's say you're not going to have to sell it. It's just you think you're going to be able to hopefully recover some of that decrease. Then the next question, which you can see item 3, is we have to identify, is a portion of that related to credit loss, or sorry, credit risk versus interest risk. So, and it's on a subsequent slide, but the guidance does dictate that for available for sale securities, that analysis has to be performed using discounted cash flow to determine what you're expecting to get. So for question 3, you would run the discounted cash flow. If that discounted cash flow, that will tell you how much of that decrease needs to be a credit loss. And then if you follow that chart to the right, you can see that any other remaining loss goes into an other bucket, which generally speaking would be the interest related risk. So we're going to walk through an example of this to maybe hopefully putting some numbers to it will solidify some of those concepts. So our example, ABC Insurance purchases a corporate bond issued by Money Farmer on January 1st for $1 million. They've classified it as available for sale. So we're looking now at the end of the first quarter as of March 31st. The amortized cost or the current carrying value of that bond is still $1 million. The fair value, should have reversed the order there. The fair value is $900,000, and the discounted cash flow comes back. The value would be $940,000. So if we go back here for just a minute, our first question is it impaired? Which, since the current fair market value is $900,000, that says yes. So we need to do something. If we go back to the facts, that last bullet point says we don't intend to sell. We don't think we're going to have to sell it. So sorry to keep going back and forth, but so we can answer no to those next set of questions. So we get to question number 3, is any of this loss credit related? So the good news is we didn't make you do the discounted cash flow. We're not going to cover that in our training today. But we can see here that we have the discounted cash flow number that tells us of that $100,000 decrease in value, $60,000 relates to credit loss, because that's the difference between our carrying value and the cash flow. And then the remainder would be related to the other risk, or in this case, we're calling it interest rate risk. So we're going to look at the initial entries, and again, we're going to ignore taxes. So the purchase looks exactly the same. You debit your asset, credit the cash going out. March 31st. So the way as we've kind of thought through this, and as each of you look at your own, chart of accounts, you can decide this, but we kind of envisioned that it would be, you have your asset account, your mark to market account, and then an allowance account as well, because you are going to want to track separately what's running through OCI as just a regular mark to market versus what is running through as an allowance. So in this case, because we determined that the credit loss amount was $60,000, you can see our debit would be to the P&L in some kind of, however you want to label it, credit loss account, and the credit would be to an allowance account on the balance sheet. And then for the portion that is related to the interest rate risk, that still runs through OCI just like it has before. So again, you'll see the debit to OCI there for $40,000 and the credit to your regular market value account on the balance sheet. And then the good news, well, I don't know if it's good news, but maybe just if you're evaluating, so that was March 31st. So let's say we get to June 30th and you do your discounted cash flow again, and that balance has changed between what's related to credit losses versus what's related to interest related losses. You can make that adjustment. So for example, if we're looking at June 30th, we're still going to say that the fair value stayed at $900,000, but we reran our discounted cash flow and it came back at $950,000. So now our amount related to credit losses is just the $50,000, and 50 relates to interest. So you would book an entry along the lines of this that reverses some of that out of the P&L. So you can see that we're crediting the P&L with credit loss income. Sounds like a weird term, but that would be the same account. And then debiting OCI for that amount to adjust the allowance versus the mark to market. And let's see. Okay, so again, this is how to determine if impairment is from credit loss. So it does give you, there's a list of factors that suggests you consider, but where that, if we go to the very bottom where it does dictate that you have to use discounted cash flows, hopefully most of these things like the payment structure, the likelihood of future payments, and some of those things are reflected in, the interest rate maybe you're getting back on that bond or the factors going into your discounted cash flow. So we're not expecting to see any other factors outside of the discounted cash flow. So meaning that once you get that number, we wouldn't expect you needing to adjust that afterwards, that you're pretty safe to say, based on, our last example, that portion that we calculated using discounted cash flows is credit and that everything else is interest related. So the adoption method, there's a couple of things to consider. So generally there's the modified retrospective approach. So you can calculate what the cumulative effect will be of that adjustment, and look at what it would be at the beginning of the period and adjust retained earnings for the first period you're reporting. The prospective approach, where you've already recognized OTTI. So if you have written down a security, you just use that as your same starting point for the basis of what your calculation would be. And I think that's all I have before we look at disclosures. I can see there's a question, Cameron. I don't know.
Yeah, the question is whether there's a download of the presentation.
Oh, yeah. We'll send out slides along with like the CPE certificates and all of those things after the training.
Available on our website too.
Yep. So hopefully that's not the worst news, other than, like I said, it's a little bit more effort in that it's by security. And again, similar to CECL, depending on what kind of information your investment broker or maybe your reporting entity, if you're using a third party to help with that, can provide, they may be able to provide some assistance. But with that, I didn't put, I don't know if there's another polling question or if that's later.
There will be.
There will be.
Yeah, there's
Okay.
another.
Just wanted to make sure I didn't miss anything. So I am going to turn it back over to Diane to talk about some of the disclosure requirements for all of these changes. Oh, there.
All right, so it's kind of like we talk about debits and credits, and that's my favorite part, but I feel like sometimes with disclosures, that's where the real fun begins, right? So Allison and I mentioned, both of us during our presentations, just that your service providers, be it your investment broker, investment advisor, your if you do have an investment reporting service such as Clearwater, this, if they weren't helping you before with it, hopefully that you'll ask them and reach out, because a lot of the data that you need for all of this, that it's at their fingertips, it's at their disposal, and they should be able to get you in some really nice organized manner to help with all of this. So held to maturity disclosures on credit risk. First, you want to look at credit quality. You want to talk about the description of credit quality indicators, amortized cost basis by year of origination or vintage within each credit quality category. And then allowance for credit losses, you look at the description of the methodology and the estimate process, including factors considered to incorporate past events, current conditions, and future forecasts, and the reversion method applied if applicable. And then the roll forward of allowance for credit losses activity during the period. And we do have some examples for you here. So kind of put some information here to give you high level what you need to gather, and we'll show you some examples. So continuing on there, past due status, looking at your aging analysis and disclosing amortized cost basis by portfolio segment or class of receivable. The entity's policies for determining delinquency status and when it considers an asset to be past due. You need to look at your non-accrual status, the policies for the entity, amortized cost basis of assets on non-accrual status and assets past due 90 days or more, by not on non-accrual status. Sorry, that should say but. Amount of interest income recognized during the period on non-accrual assets, and then amortized cost basis of non-accrual assets for which there is no related ACL. And then continuing on, like I say, this is the fun part. Write-off policies, you need to look at what is the entity specific policies for recognizing those write-offs. So you just need to disclose the specific policies for the entity. All right, available for sale debt securities disclosures. Again, we'll go through a few examples here in a minute. You need to parenthetically reflect amortized costs and allowance for credit losses on the balance sheet. Specific disclosure requirements also relating to your available for sale debt securities and an unrealized loss position for which no allowance for credit losses has been recognized. And that's because you're saying it was permanently impaired in the example Allison showed us, that it's impaired and you have to sell it. So there's not an allowance there. It's a write down. It's an actual write down of the asset. You're available for sale debt securities with allowances for credit losses, and then the roll forward of the allowance for credit losses. All right, so some examples of disclosures, and we just took these from the public filing for Allstate. So they talk about the adoption. I'm not going to read through all of this. Again, we'll make these slides available, but that they just talked about, the first disclosure talks about the actual adoption, and then refers you to another note that has the more detail on that. Again, I wasn't going to read through all of this. It's just talking about your measurement on credit losses, and just in narrative form disclosing what some of those amounts were and some of the policies there around the standard. So here is the different asset classes and how they're impacted by the standard. So, and then here's the roll forward that we referenced here of your credit losses for fixed income securities. This might be the most straightforward one, right? Your roll forward. And then here we're looking at the gross and unrealized losses and fair value by type and length of time held in a continuous unrealized loss position. Full disclosure, this is one of my least favorite footnotes. It is a lot of data you have to keep, and you have to keep data for at least 2 years to do it. So this one's my least favorite. If you guys were ever going to quiz me, this one's my least favorite. It's a lot of work. So this should look familiar to us because we've had to prepare a similar disclosure here on this one. So all right, this one looks at our gross unrealized losses by unrealized loss position and credit quality when we're looking at investment grade securities and then below investment grade securities. And some notes on that. Again, I'm not going to read through all of this. We really are providing this so you can come back and look to it as you go through the process, just having some guides on this example of additional disclosures, just talking about definitions and policies of the specific entity. And it discloses that decision about not selling and that they're not required to sell, essentially saying they're not permanently impaired and an allowance was established. And again, lots of good stuff here that I'm not going to read through in detail, but some good examples of the policies that need to be disclosed as part of this new standard. Okay, and this example disclosure talks about mortgage loans specifically. So this is showing mortgage loans amortized cost by debt service coverage ratio, distribution, and year of origination. So again, there should be data that should be readily available. If you're not sure if it is, that now's the time to take a look at that. Make sure that you do have access to this data. And then again, your roll forward of credit loss allowance specific to mortgage loans is an example here. And with that was a lot, I know, of information. And like I say, that was meant to kind of give you a feel. And we'll pop up our participation check poll question here, but presenting that to kind of give you a feel for what those are going to look like and what you'll need to gather. But again, that's going to be really tailored to what your entity has, and as you go throughout the process and the data you have available and all those different things. But again, we're here and available to help you work through that process, talk about maybe what we're seeing other entities doing there. And like I said, that was all information just provided as a guide to kind of give you a feel for what those disclosures will look like. Give it another 30 seconds on our attendance check.
Just take it.
Oh, nope. Cameron said no. Cameron's done. Okay, thank you. Okay, and with that, Allison, yes.
One other thought that I just had that we neglected to put in our slides is with the new guidance, the FASB also gave a one-time election to say if you're currently classifying things as held to maturity or available for sale, you can move them to trading, which obviously then changes the accounting altogether. And not that that's a solution probably for most people or most organizations, but if as you're looking at it and maybe it truly is that you are planning on buying and selling and you've had them as available for sale, that may be worth something considering. And again, like is up on the slides, reach out to us and we can go a little bit more into detail on what that entails, but know that that is an option to elect to fair value.
Right.
And treat them as trading.
Yeah, just a reminder, once you've classified as trading, then all of your change in fair value runs through your profit and loss. There's no buckets, it's all through the income statement. And if you make that election, the kicker is you got to be consistent. You need to have good facts and circumstances. If you're gonna then change that classification in the future, there needs to be some, you need to be consistent and you shouldn't be trading back and forth. So say you do trading, you elect to classify as trading because they're all in a gain position and you're saying there's no credit, there's no expected credit loss, but then the next year they're all in a loss position and then you decide you want to go trading, you need to have good justification. You can't go back and forth on that just because of the position that the security's in. It's kind of a one-time shot on that. And you should not be changing back and forth. You need to be consistent. So thank you, Allison, for reminding us about that. So did we have any other questions come in, Cameron?
So,
Okay, awesome. Thank you all so much for hanging out with us while we talk about this new standard. And as always, Larson and Company's here and ready to help you with this, help answer questions in any way that we can. So if you do have additional questions as you're going through the process, please feel free to reach out. And with that, we are going to take a quick minute and we are going to switch because our tax team is ready and waiting to present some great information about preparing tax provisions. So we are going to get things switched up here for just a minute. All right.
All right, we're back talking about income tax provisions now. I'm Jason Parker and Craig Swindlehurst is with me as well. So we're gonna kind of start basic, and if you have questions as you go, please type them in. And we'll be talking about statutory income tax provisions, but there's a lot of, it's kind of almost a hybrid of GAAP and stat. And we're going to go through some examples. We'll look at some spreadsheets as we go. So we'll jump between our slideshow and our Excel, basically what we use for our work papers for preparing income tax provisions. So I want to start with talking about a little bit of why, what a provision is. And so in order to properly compute and record in your financial statements, your income tax related items, we have to go through the current taxable income and deferred taxes as well. And so for your current piece on the balance sheet, you have the income tax payable or receivable, and on the income statement side, you have the current income tax expense or benefit. And then your deferred income taxes on the balance sheet, you have your deferred tax asset or deferred tax liability. And we'll talk through, we're going to walk through some definitions, and so we'll get into a couple of these things a little bit, explain a little bit more. But for the deferred part, we have the DTA or DTL, and on the income statement side, then you also record your deferred income tax expense or benefit. So let me pull up a couple of examples.
go to the next slide, please.
Next slide. And I got out of the, okay. So, yeah, we want to, as we start using terminology, I just want to make sure that everybody knows what we're talking about. And you're probably, I don't know, maybe a lot of people are familiar with this already, but we'll go through it. So, book tax differences, or what we'll refer to sometimes as M adjustments, are items that are different under statutory or GAAP accounting. They're different when you compare them to the federal tax rules. And the difference, there's a difference when there's a difference in the current year income. So there's either a difference in the current year income or a difference in your basis of the asset or liability. And then when we look at the book tax differences, they're either temporary or permanent. And so so a temporary difference, we're gonna look at some of the examples. We'll see how over the life of the asset or liability, the book tax difference ultimately nets to zero. So in the end, are treated, the complete treatment, I guess, is the same, but there are timing differences throughout the life of the asset or liability. And so in the end, the book and tax will net out to zero. The permanent differences, we'll go hit a couple of those. The difference between those will never reverse between stat and tax. So they're obviously permanent. Now do I want to go through, look at a couple of those?
Yeah, pull up the Excel. I mean, this is really, again, pretty big. It's very basic,
Yeah.
but I think that really just to show a really simple example, depreciation of fixed assets, right?
So yeah, you have, if you purchase something thank you. Let's see.
Yeah.
Should I do a little bit bigger? Is that good?
Maybe a little.
Okay. So let's say we purchase an asset for $75,000 and you record that in your fixed assets. And so for the stat purposes, you're gonna depreciate it over 5 years or however many years the life of the asset is. And so in your first year, you have $15,000 of current depreciation expense. And for tax, it will take a bonus depreciation or you may use a different method. And so your tax depreciation is going to be different from stat. And so at the end of the year, let's say if you did use bonus depreciation, at the end of the first year for tax, your whole asset has been depreciated. So your basis is now zero. But on your books, you still, you have a basis of $60,000 left in this example.
And I think the key is whenever you have a temporary difference that causes a difference in your income in a current year, there's going to be an associated difference in the basis of your asset or your liability.
Mhm.
Is that fair?
Mhm.
And so the only time this doesn't happen, it's a permanent difference. You have a difference in book versus tax income, but there's not necessarily a corresponding difference in the basis of the asset. So I think this example is nice. Just, I mean, very simple. Again, your difference in your incomes is you can see now that how the difference in income affects the difference in the basis of your asset. And then the next
Right.
slide will kind of go through the life of a.
Yeah, so if you look at the future years of depreciation, then so like Craig was just pointing out, in the first year, your difference in the basis is 60,000. So now once we've already depreciated everything for tax, oh yes, thank you. Then follow to my next tab. So in the next year, your depreciation for your books is going to be the same, $15,000, but for tax, you don't have any depreciation since it's already been depreciated. And so at the end of that year, then your basis is going down for book, but the basis for your tax has already gone to zero. So, but you see the basis now approaching throughout the next years, approaching zero. And by the end of the life of the asset, then you've recognized for book purposes the $75,000 of depreciation that you recognized all of in the beginning of the first year, or on the first year for tax purposes. So like we said, yeah, a basic example, but that illustrates how when you have, in this example, depreciation, what the book tax difference is in the first year and what it is throughout the rest of the life of that asset.
Guys, just remember, we'll have to slip in polling questions during the part.
Okay, so
My
we just let
pleasure.
you, my pleasure.
Whenever you're ready to stop and play.
So we wanted to point out just some of the common book tax differences for insurance companies. And we've noted them with a P if they're permanent items. And as we continue to go through, maybe refer back to this to discuss any examples or discuss any questions. But so with investment income, there are a number of book tax differences, and your capital losses will create a book tax difference. Your unrealized gains, as recognized for book purposes, are not recognized for tax purposes. Your tax exempt interest and dividends received deduction are permanent differences, and down here, then there's proration for both of those tax exempt interest and dividends received deduction. And for PNC companies, which back up to really quickly, when you look at property and casualty or health companies, most things are treated the same. They both file 1120 PC, and so a lot of these rules apply, are the same for PNC company and health company. For life insurance companies, there are some different rules, and so the proration adjustment for PNC companies is a 25% adjustment, whereas for life insurance companies, it's 30%. And another major difference is always going to be your federal tax expense, which is a permanent difference because you don't deduct your federal tax expense on your tax return. And then two main ones that many people might be familiar with is your adjustment for unearned premiums. For tax purposes, you take a 20% haircut, and you take the 20% adjustment on the change year over year. And then for your deduction for losses, the tax code makes you discount those losses, and so there's always a book tax difference for that. We'll also go over some accrued expense adjustments that are required for the provision for calculating taxable income. Anything else on these?
We're not gonna go into a lot of detail calculating, going through like the rules behind the books tax differences. We just wanted to mention them so you know kind of as we go through our example what they are, but we'll focus more of our time on the computation of the provision and less so on how do you calculate this or that book tax difference. If that makes sense.
Yeah.
Sure, pull it up.
They just launched.
It is our pleasure to have you here.
Can't respond, but it is a pleasure.
Okay.
Maybe a few more seconds here.
Cameron's seconds go really quickly though, so move fast.
Just playing hide and seek with my kids.
Yeah.
Okay, ending 5, 4, 3, 2, 1.
All right. Hopefully everybody got it in there. And so to continue the basics, I want to talk about some of these terms. So temporary differences give rise to a deferred tax asset or liability. Permanent difference does not. And so your DTA or DTL, which is your deferred tax asset or deferred tax liability, comes from those temporary differences. And they represent the tax expected to be paid in future years, based on your current year temporary differences that will reverse. So deferred tax asset is a future tax deduction or something that you can exclude from income in the future. Whereas your deferred tax liabilities are going to be a future add back of deductions, like we saw with the depreciation. You know, you'll see in the books $15,000 expense, but for tax purposes, you're gonna have to add back that expense since you already taken it. So that when, in that example, when you take a bunch of the depreciation for tax up front, like it's gonna create that deferred tax liability. And then we talk about them sometimes in terms of gross. We look at what created that DTA or DTL, but then they're always recorded in the financial statements on a net basis. So after you apply the tax rate, which for now, the tax rate is 21%. So it's easy to apply that when it can be more complicated when it's not all the same rate.
The spreadsheet.
These examples.
Yeah.
Let's see, I'm in here.
Yeah.
All right.
So this is the same example as before. So now just to bring that terminology to an example. The depreciation expense, this difference between your stat or GAAP accounting and your tax accounting created this temporary difference. The difference in the basis of the asset at any given point in time, this is the gross deferred tax asset or liability. That's what it's called. The difference in the basis. And so after year one, we say, hey, we've got a $60,000 gross deferred tax liability. And like what Jason mentioned earlier, deferred tax liability means, in essence, that we have a tax liability in the future. And in this case, it's because, hey, we've already taken we've taken the full depreciation, but book is still going to record all this future depreciation, but we're not going to be able to take it for tax purposes. So that represents future add backs to our income, meaning future tax. And so this is the gross number, but as Jason mentioned, it's recorded in the financial statements on a net basis. So as you do a provision, as we go through the steps in our example later, you'll see first you kind of figure out what are my current year differences between book and tax? What are my gross deferred liabilities or deferred tax assets? And then over here, we just tax affected it. This is what actually gets recorded in your financial statements. So if you were doing a tax provision just for year one, and this was your only difference, what you'd end up recording is a $12,600 liability to your financials to represent, hey, I've got 60,000 of future add backs that I'm basically not going to be able to take this $60,000 tax in the future, or I'm sorry, deduction in the future. So I'm going to record a tax liability related to the $60,000 that I'm going to have to add back in the future. And so you see, as the life of the asset goes on, and book starts recording that depreciation, and this difference, this gross deferred tax liability, which again just represents the difference in the basis of the asset between book and tax, as that continues to decrease, our deferred tax liability continues to go down because we have less. We're recognizing some of the liability now, and we have less to recognize in the future. So this just, it's a decent example showing the life of not only Jason went through the life of the asset and showed how the total expense for a temporary difference eventually is the same for book and tax, but this shows how kind of the life of a deferred tax asset or liability how each year when there's an adjustment, it goes down. And then we kind of have a similar example here with unearned premiums. Again, this doesn't really tell us anything new than what we've already talked about, but again, the example, and we'll send these examples out, not that you may not need them at all, but again, what this example proves out is that with a temporary difference, your income for book and tax is going to be the same over the life of the asset. In this case, it's not an asset, it's the life of the liability. The liability is unearned premiums. So we have these current year differences that give rise to this is the tax affected amount of the difference in the liability basis. These temporary differences are giving rise to these deferred tax liabilities. And over the life, the income's the same, and you can see how this column is your deferred tax asset. And again, just to clarify, in this case, we have a deferred tax asset because with the unearned premium adjustment, for stat purposes, you know, stat doesn't have to recognize this 3.2 million of unearned premiums into income. But for tax purposes, we have to pick up 20% of this into income. So essentially for tax, we're picking up an additional $640,000 of premium income into our return in year one. And that means that we have $640,000 less that we have to recognize in the future. And because we have less tax to pay in the future, because we're accelerating this 640, we have an asset, meaning, hey, I've got less tax in the future to pay. So I'm going to record this tax asset, meaning, hey, I prepaid this tax essentially. You know, stat, they're going to pick up all this income, but we don't have to. So I'm going to record this asset. So anyway, I think these two tabs are helpful just to understand the life of a temporary difference, the life of a deferred, and how over time, everything is going to equal out. Like your tax rate is going to be the same. Or the tax liability for a stat or gap or tax is going to be the same with temporary differences. It's just a matter of timing. So hopefully that made some sense.
Yeah. So a few other terms we'll talk about are when we talk about our tax accounts. That means any of your income tax related trial balance accounts, which are important to look at all of them and how they are affected. Income tax payable is your net tax that you expect to pay, or income tax receivable is a net refund or overpayment that you expect to receive and want to record. And sometimes that will include your current amount, but it also could include a receivable you'll have from different carryovers and whatnot. So that can be that can have a few different components. And then another term that we use a lot in the provision is your RTPs, or your return to provision true ups. These are the differences between what you calculated when you did the provision and then what happened actually on the tax return. It's nice when those are the same, but that's not hardly ever the case. So you'll have true ups to record, and when we walk through some of the steps, we'll show kind of what we do to make sure we get all of those. And then your rate rec is an important part. When you do your tax provision, there are required footnotes, and so the rate rec is a big piece of that. And that shows the rate rec proves out why there's a difference between if you take your pre-tax book income and multiply the tax rate. You might expect, well, that would be what my tax should be, but it's not going to look like that. And so your rate rec shows what are all the differences that get me from 21% of my pre-tax book income to what tax I'm actually recording. So next is we'll start talking about just kind of the thoughts in Craig's mind of,
Greg's not.
well, hey, I'm crediting you for this proprietary
Yeah,
process of preparing it.
copyrighted.
well,
Yes,
I-
tax provision.
this is, as Jason and I
That's Craig and I
discussed,
discussed
this was essentially this, like,
what we go through.
the order that we
Yeah.
would go through if we were preparing a tax provision.
Craig was
And-
just good at articulating steps. I just get in there and just do it. So.
Well, and I was gonna say that it's not like the gold Bible, like,
That's-
I'm sure
that's
people
true.
have a different process, but if, I'm just saying, if we were handed a provision, we'd probably go in this order. So I mean, I think that's what we want to do with the rest of our time, is to open up
Some
it-
examples.
like, yeah, like a provision file that we created for a fictitious company, and kind of walk through, okay, here's the steps that we did. And then show how it all balances in the end and everyone's happy. So,
Yes.
Do you wanna do a quick poll
Yeah, let's do
Yeah.
another question.
Before we dive into that fun.
Yeah, strap your seatbelt.
Oh, look, really quick.
Buckle up.
Oh, it's a different kind. Ah,
Mix it up. We'll just have one more after this one, so.
there's not none of the above.
Yeah, that wasn't a choice on purpose.
Sorry.
Thought about putting a choice instead of pop.
We'll just have one more. We could do it at the end.
Okay, okay. Hopefully you've answered all of those then. There will be one more at the end.
I'm gonna give 5 more seconds here. Guys want to see these results?
Yes, absolutely. Oh, good. CECL one.
Oh, yeah.
It's because Allison like came in and said, this is the worst one.
Yeah. Right.
Really have to buckle up for that one.
Okay, so
Maybe we go straight to the end of the Excel now.
Yeah, let's- we have some, yeah, we have some tabs we might, or some slides we might come back to when we talk about admissibility, but what?
Yeah, hopefully we don't have time for that.
Yeah, hopefully we don't.
Good stuff. If you want.
How much time until the people get the minimum 2 hours?
So we started at 9:30, so
So-
I guess it's,
In theory, 11:10.
yeah, because we're accountants and 50-minute hours.
I mean,
Yeah.
we'll go through. fair enough, but-
It's all good, yes.
Okay, thank you.
You aren't using a mouse.
There is that mouse right there.
It's not like my mouse. Something is. Sorry, hold on, everybody.
Is it not letting me edit it? Is it- Maybe hit escape, try that. It's just taking a minute, oh, the big workbook maybe.
It's not-
Sorry, I saved it on the desktop to try and make sure that it was gonna.
Should be fine.
Was it good?
Do you have you probably have a link to some random,
Yeah,
Oh,
probably.
just even break the link.
but until you get through all these windows.
Yeah,
Escape right
yeah,
now.
just a lot of times.
Hey,
Oh,
one did
good.
it.
Okay, I was gonna say, if you want to break them real quick, are you okay? I think you'll be okay.
I don't know.
Now that it's open, you'll probably
You should be okay. Okay.
Okay. Okay, so what we'll go through first is when you start the provision, you want to roll forward what you had on your prior year provision. And
We're
then-
talking specifically about your deferred balances.
Yes,
You had your ending, you had your deferred tax assets and liabilities from last year. You just want to roll them forward so that now they're the
the
beginning.
beginning balance. So when you look at, so if you pull up your prior year, then in this column, in this, oh, sorry, let me go in. Martha already mentioned. Scroll, zoom in a little bit. So the cumulative differences, like from your prior year, are gonna be the balances that you want to copy and put over here. as your beginning balances as you're starting this year's provision.
And again, with deferred balances, I think it's important to note, all these numbers, right? We're talking about cumulative differences. So your deferred balances, again, what they represent is I've got a difference in the basis of a book gap stat asset or liability, and then a basis in my tax. And the reason I have differences is because I have these different rules about when to expense things or when to put things into income. So again, your deferred balances, these all relate to temporary differences that over the life of whatever we have, these will all eventually go to zero. Right now, though, and again, well, I guess this is Jason Parker Insurance Company. And this is year 2. So in the first year of its existence, it recorded these differences between book and tax. And so as we go into year 2, last year's differences become our beginning deferred balances, which just represent, the cumulative differences in book and tax related to these different assets and liabilities. So like the fixed assets, for example, in our example, and maybe we should have done this, but oh wait, it works.
Yes,
It does work.
Good job.
So in that example we had, after year 1, we had no tax basis in our fixed assets because we took a full $75,000 expense in the year before. I'm just going to call it book purposes, and that encompasses gap stat, whatever. So for book purposes, we took $15,000 of depreciation. So there's still $60,000 of book basis in the assets, and that's why we have here our starting point is, hey, I've got a $60,000 difference in my asset. That's going to reverse over time, but that's kind of, what's going on there. Hopefully, I mean, it'll make more sense, I think, as we go through a current year.
So so once you have those beginning balances in place, then you're going to want to look and see what you calculated on the provision, and then what the tax return actually looked like, and then include those differences in this true up column, so that then you get to, because so like Craig was just explaining, when you did the provision last year, you had these differences in the basis of your deferred items, but then something was different when you actually did the tax return. So you want to get to what the true difference is, because there were, well, let's look at a couple of these. So your tax exempt interest and your tax exempt interest was the same, but your DRD was a little bit different, and that'll happen frequently. That's a good example of one that will be different, because when you prepare the provision, you really won't know at that point what your DRD is going to be. And so so because the DRD was a little bit different, then your proration was also different. And so so then if we look back on our reconciliation tab and the permanent section, those are both there to show the true up. Now this, and maybe you're going to mention that, but so the treatment of the true ups for permanent items will go through your rate rec, right?
Yeah, and you'll notice in this permanent section, we don't have anything for our beginning balance. And that's because, like we mentioned before, permanent differences, you don't record deferred tax assets or liabilities for permanent differences because they're never going to reverse. Like that DRD that we're saying, hey, we overstated it by 5,000. That's never going to reverse, where in a future year it's going to be negative 5,500. that difference is always going to exist. And so we don't carry any like balances, deferred balances related to permanent differences. So the purpose of the true up of permanent items is just to say, hey, we were wrong. You know, we used some estimates on our provision. We understated our taxable income on our provision by 4,125. And so in the current year provision, when I'm recording what I should put for my current year expense, I've got to take that into consideration. Hey, I underreported my income. So I'm going to true up for that, and I'm going to record this 866 is just 21% of the 4,125. I've got to record that $866 into my current year expense because I didn't do it last year and I was a little bit wrong. So this true up column, I think the purpose is twofold. One is to say, well, because we used estimates and the return ended up being a little bit different, I've got to true up my expense because my expense last year was either over or understated, and I need to make up for that this year. And then the second purpose would be on the deferred side, on these temporary differences, to say, well, if I was wrong on the calculation of my temporary differences, not only do I need to true that up in this year's expense, I also need to make sure that here in column H, that my beginning deferred balances are what they should be. Because at provision time, again, I used some estimates. I may not be, I was a little bit off. So I want to make sure that I true them up here so that this column H is my adjusted beginning. All these beginning deferred balances now will tie to the tax return. So yeah, I guess twofold. True up your balance, your deferred balances on your balance sheet, and then also run the true up through your current year expense since you didn't last year.
Do you want to go through any of those examples of the temporary
Well,
differences?
I mean, you could just say like, oh, we thought we were going to have at provision time, we estimated our loss reserve discounting. We said, oh, we're going to have to add back 156,000 into income. When we actually did the calculation, it ended up being 95. And so that difference, that 60,000, yeah, I mean, it just runs through here to adjust our beginning. So this beginning number is now correct. If I were to look at my tax return or my tax return work papers and say, what's the difference in the basis of my loss reserves? This would be the number that tied to the return. And then, yeah, I mean, I think that's it. I think that's basically step one. Is we took our balances from last year's provision, we trued them up for any differences that existed on the return. And now we've got a clean, good starting point. These are the correct deferred balances that tie to the return. And now we can go forward into the current year, like calculating the current year liability or.
Right, which is the next step, calculating your current year amounts and you look at your current taxable income to get your book tax differences. It'll then go in your current column, and part of this step is kind of the next step with it is you're looking at what those current year amounts are in order to get to your ending deferred balances.
Yeah. So the next thing we would do is we'd say, okay, we've got a good starting point with our beginning deferred balances. Let's go through the current year trial balance. Here's our beautiful trial balance. The balances, everyone, look how it balances. It's so great.
Yes.
Let's go through our current year trial balance and let's calculate the current year taxable income. So that's essentially what this section is doing. We added a bunch of tabs that will be helpful in showing kind of how the relationship between this year's book tax difference and our ending deferred tax asset or liability balance. So and again, like I said, we're not going to go through like the calculation of all of these different book tax differences, but from a high level, I'm just going to hide these. We start with our our book income from the financial statements. And then in this column J, we basically run all of our book tax differences through to come up with this column K, which is, so here's our book income. Here's all of our book tax differences to come up with, hey, this is our taxable income at the end of the year. Because we don't have an NOL. We're gonna have an NOL. Something.
Yes.
So, and again, like back to what Jason showed earlier in the slides, your common book tax differences. I think we actually included all of these items somewhere in here, but if we were just to run it through very high level, you know, your premiums, you have a 20% haircut for tax, your loss reserves for tax purposes, they get discounted. And so there's always a difference between your loss expense. Oh, this is a life insurance one. Jason's messing me up. Let me go to the beautiful.
We've been, well, we made two separate.
We
ones.
made what we
might have
made
been
one, and then
changing
Jason transformed it into
You guys are just
PNC.
trying to keep each other on your toes.
Yeah, yeah.
Good job.
Anyway,
because this one has.
yes. So here at salaries, sometimes there's differences in how in accruals, book may record certain accruals related to payroll that we can't deduct for tax purposes. So that's what that difference relates to. You know, entertainment, fixed assets, here's a difference in depreciation, and then all your differences in investment income. So anyway, again, we're not going to go through the detail of how you calculate each thing, but I think the third step is, okay, I have my beginning deferred balances correct, and now I've calculated my current taxable income to the extent that I could at provision time. A lot of times there's certain information missing, and so you make estimates, but in this section, let's just pretend that we all agree with all of these numbers, that everyone's on board with these book tax differences. And this, even though we recorded 200,000 of book income, after our adjustments, we've got a $80,000 taxable loss. So that's the next step. And then now the question is, okay, well, I'm done, right? We have no tax liability. And it's like, that's my tax expense, boom. And it's like, well, there's a little bit more to it. So now the question is, you know, in these columns, we've identified which ones are permanent, which again, permanent, you don't do anything with deferred tax assets or liabilities. These don't impact that at all. And then we've identified the ones that are temporary, the ones that do have differences. And I think now going back to this tab, so we've done steps 1 and 2, and now we're moving on to step 3, which is, okay, we rolled it forward. We did our return to provision true ups. We calculated our current taxable income. And now we need to make sure that, yeah, all those temporary differences that we came up with, we need to make sure they're running through our deferred tax asset and liability schedule so that our ending deferred tax assets and liabilities are correct. So here we are back at this tab where we in column H, we came up with our correct beginning deferred tax assets and liabilities. In this column I, we have current provision. And if you start here with your book income, and as you go down through this section, you have these are your permanent differences between in terms of current year income. And these are our temporary differences. And I'll come back to this, but as you keep scrolling down, you'll notice that this taxable income here, 80,000 2019 is going to agree to this 80,219. And so we basically re-input our taxable income calculation in column I. And the reason we do that here is because this is our deferred schedule. We want all the current year temporary differences to run through our deferred schedule, because our deferred tax assets and liabilities need to be updated each year for current year temporary differences. And I think an important thing is to say, well, this is a really, I think this is a big part of the provision, getting these numbers right, because, you know, if your current year temporary difference is right, but your beginning is wrong, then your ending is going to be wrong. Conversely, if your beginning's right, but you record this wrong, so there's certain check figures as you build out provision work papers where you can say, okay, I've run all these temporary differences through. I think these are right. And the question is there a way I can check this to like give me some comfort? And again, these deferred tax assets and liabilities, they represent a basis difference in an asset or liability when I'm comparing book and tax. So going back to our fixed assets example, this 60,000 is really, if you look at the basis, the net basis of book fixed assets and tax fixed assets, the difference was 60,000. So that's like a good check figure in a sense to say, oh, okay, that beginning number is right, because when I look back at this, that's the difference in my basis. So I'm pretty comfortable that my gross deferred here is correct. So what we wanted to show is going through these different temporary differences. If we go through and look at some of these work papers, we're going to find these check figures, and I'll show you kind of how that would work. So unearned premiums, we've got a difference because tax recognizes 20% of unearned premiums each year. Book doesn't do that. And so tax has essentially picked up more income. And so we've got this deferred tax asset. So if we go over here to this is our unearned premium work paper that we'll use to calculate a book tax difference. So in this particular row, we've input our ending book unearned premiums, which that just comes straight from the trial balance. This is our trial balance. There's our unearned premiums for book purposes. For tax, our basis is different because we picked up 20% into income. And so our unearned isn't 2.7 because we've recognized 20%. The unearned premiums for tax is actually 2.16, which is 80% of this because we picked up 20% into income. So there's this basis difference of 540,000 between the unearned premiums, and it's highlighted in green because I can look at that basis difference between the book liability and tax liability, and I can tie that right here to this 540,000. And in most cases, you should be able to do the same thing or at least be able to compute this for all your ending deferreds in a perfect world. So like, again, I'll go through this quickly. If I have an ending $264,000 DTA, what I'm saying is I've got a basis difference between book and tax for this particular liability. And so if I jump over to my loss reserve discounting work paper, and I've got a basis difference of 264,000, I can find that right there, which is the difference between book reserves from the balance sheet in the trial balance and then tax. And again, we're not going to get into how tax reserves are computed. There's discount factors and tables and all that stuff, but there I can tie and say, boom, there's the tie out. That's how I know. You know, fixed assets, same thing. We kind of went through fixed assets. I won't do that again. Capital loss carry forward. I should be able to say, well, that should equal my capital loss carry forward amount. And if I go to my capital loss work paper, there it is, 16,005. So anyway, as you're going through your current year differences and your ending deferreds, there are ways you can tie this out to say, okay, well, let me go to the specific asset or liability and look at the basis for tax and the basis for book, and that difference should equal my ending deferred. And if it doesn't, then you can always run an adjustment through this year to true it up. But typically, I think that's the tie out, is these ending balances should equal the differences in my asset or liability between book and tax.
That's your gross amount?
This is gross, yeah.
Yep.
And the tie out only works with the gross because, you know, all assets and liabilities they're not tax affected. So Kim brings up a good point. These gross deferreds, like this is, we compute this, but then this isn't how they're recorded in the financials. You're not gonna see, yeah, like, because what we're saying here is, oh, I've got total deferred tax asset of 341,000. So I need to record that in my financials. And the next step to take is say, well, wait a minute, first you've got to, and this is what Jason mentioned in the slides, recorded in the financial statements on a net basis. So before you record, let's say you get to this point, you're like, hey, all these are tying out. I know my basis for book and tax, and this all makes sense. Before you put it in the financials or anything, you tax affect it. So this column is just the gross deferred multiplied by your tax rate. And then this is what actually goes into your financial statements. This number right here, my net deferred tax asset. Is everyone sufficiently confused?
You just audited the tax division, by the way.
Yeah, my own.
Yeah.
That's what we do.
Jason Parker Insurance
You're an
Company.
auditor now.
Okay, I mean, I think
So-
that's step 3, kind of.
Yeah. And so then I guess before you do record it in the financial statements, you do have to walk through what amount of it can be admitted. And we put in the slides the SAP 101. that deals with that.
Yeah, but due to time constraints. And understanding that there are probably a lot of people on the call that deal more with GAAP provisions.
Yes.
You know, we've got, there's these tabs that determine how much of your deferred tax assets you can admit.
And basically, yeah, you look at what taxes have you paid in the past that could be recoverable through your DTAs reversing. Then you also calculate, which some of you may be more familiar with, this RBC ratio. The SAP 101 wants you to look at what your ex-DTA RBC ACL ratio is. And that will tell you basically how many years forward you can look at, and what percent you can admit. So there's 2 steps to that. And then the last step of admissibility is what DTLs do you have available to offset against your DTA.
And that's
That's all
it.
you-
Now you
That
know.
was a fantastic summary. Good
Yeah.
job, Jason.
So,
You guys want to run your last poll?
yeah, let's do that.
Let's do that, and then we'll hit a couple other things. The Jedi trick.
Oh,
That is
nice
how you-
question, Cameron. Nice.
Hey,
I'm gonna feel bad about myself if people get this wrong.
Don't display it.
I will
Don't,
not display
don't.
the
Let's
results
keep
here.
Craig
You
on
can
a high.
answer why.
Yeah.
Let's keep him riding on a high note here.
so yes, as you all answered correctly, the difference between book and tax depreciation causes a temporary tax difference.
Okay, Cameron, no tax.
Okay, I'm gonna end the poll in 5
Cameron's asking
seconds.
questions about gross and reserve.
Did you guys talk about your allowance, the allowance against, because that's.
Oh, the
applicable.
valuation
Is that what-
allowance?
We talk about that.
Yeah, you want to talk about that?
Is that applies to both?
It
GAAP
does.
and
And so that should be done before you look at admissibility.
ability, right? Okay,
Part of
great,
step 3.
great,
Uh-huh.
great.
So,
And we've got a section here. This is kind of where we.
I don't want to put you on the spot, but that's one of my favorite parts. No, I'm just kidding.
yeah.
Oh, it is?
Just
Oh,
kidding.
no. They-
They're all my favorite parts.
But yes,
Aren't my favorite?
you have to look at evaluation allowance to determine, basically, you might have like one company we worked on has been in a loss for a long time. And so they want to see if if you have any positive evidence that your recorded DTA can ever be used. Because if you're just gonna keep losing money, then you're never gonna have future taxable income to use those DTAs.
Right, so when you say use,
Uh-huh.
you're saying, if I'm already in a loss and I've got, take this premium, this means that I've got $540,000 less of income that I'm gonna recognize in the future, right?
Uh-huh.
Because it's a deferred tax asset. But if I'm already in a loss and I record $540,000 less of income, I'm still in a loss. So I haven't really used that DTA. I've just moved it from,
Change the character.
yeah, I moved it from unearned premium and now it's sitting in a net operating loss account.
So you haven't used it to actually offset
Any true tax
Tax.
you were gonna pay, right?
Okay, yeah.
So a big factor there is profitability of the company.
Yeah.
right?
Yeah, that's the
It
main
can
one.
have a big impact on what your allowance
Yes.
should be.
Yeah, and then that's, I would say that's, and maybe I'm looking at Greg, but that's the, I mean, that's the main thing.
The main driver.
If you're, yeah, is your losses, are you recording income and do you have any evidence to show that? Because a lot of, I mean, some companies that might be heavy in like development or R&D, might have a lot of years of developing something where they just record losses and losses and losses. But maybe they have positive evidence in the form of, hey, like, we're X years away from releasing this product and we have all these contracts lined up. So that may be a situation where you've got a bunch of losses that are negative evidence, but you have this kind of subjective evidence that, hey, we have this on the horizon, that you may be able to say, I'm not going to record a valuation allowance because of these factors. But I do think that, don't they look
You have
at,
to look at a time frame with that.
Yeah, and
I'm trying to
character
remember.
too, right? Like, if you have capital versus ordinary.
right?
You need to look at character.
Yeah, if you've got a capital loss carry forward, but you have no investments that can generate capital gain income, then yeah, you could record it. And I think the IRS would say, or not IRS, but the guidance would say, objective evidence is a little stronger than subjective, right? I mean, you could have all the subjective evidence in the world and all these reasons, but if there's enough objective historical data that shows, I don't know, it's kind of like it's a gray area. I remember,
A lot of judgment.
a lot of judgment and
Which is good for auditors, right?
Oh, we love
Judgment.
judgment. We love
I'm feeling it right now.
Come.
Like,
I'm
a
feeling it.
judgment from
I'm
you.
feeling it.
it. I love judging people. No, that was great. Thank you guys for talking about that piece too.
Yes,
Appreciate
thank
it.
you. The last, because parts we didn't get to is when you go to record it in your financial statements, you'll have balances already in there for different tax accounts. And so you're gonna want to come up with what the journal entry to record your correct net DTA, net tax affected DTA or DTL will be. And so you want, these steps will be kind of together when you look at the journal entry and your tax accounts to reconcile them. So
Yeah.
we'll share.
Trying to, like, this is kind of hard sometimes. So basically at this point, after step 4, let's say we've come up with, what do we come up with? We've come up with, hey, we think this is our ending deferred. We feel pretty comfortable that this should be in our financial statements. If we go down to like, this is our taxable income calculation, there's our taxable loss. So this is like a tax benefit. And if we go down, well, I should say, if you recall, the deferred piece, I think, is maybe the easiest piece, because when you get to your ending deferreds, you can really tie these out like we showed you, and you can get pretty comfortable that, hey, my ending deferreds are good to go. And so when it comes to recording your deferred, like, you've got a beginning number already that you're comfortable with. Now you've come up with an ending number that you're comfortable with. And so the difference is just essentially the change in the deferreds is your deferred expense. So like if we were doing this, we would come to this journal entries tab and we'd say, okay, you know, what's the deferred currently in the books is 111,000. We just computed that it's 71. So we need to record an adjustment, decrease our deferred tax asset by 39,000. And the offset to that journal entry is just deferred expense. Deferred, this one's pretty easy, I think. Once you have these tied down, your ending deferred balances, coming up with your journal entry is just as simple as, well, what do I have now? What do I need it to be? And that's my journal entry. And the offset goes to expense and everyone's pretty happy. I think this is the more challenging one, like to come up with your current expense and your income tax payable or receivable. So in 3 or 4 minutes, we'll try to just plow through something here. So we came up with, this is our taxable income calculation, book, adjustments, and tax. So we come down here, we say, hey, we actually have no tax liability because we're in a loss. We paid $40,000 in estimated payments. So you say, I think this is maybe like your starting point. Say, well, that's going to be an income tax receivable. I paid tax, I don't know it. So I've got a $40,000 receivable. That's kind of your starting point. That's the beginnings of coming up with this receivable. So you say, okay, that's my receivable. But then, you kind of have to consider, well, I've got this loss. I've got this income tax benefit. What am I going to do with this loss? And the reason I bring it up is to say is like, well, you guys didn't see this, but Jason Parker Insurance Company this is now, I've now moved to, this is the prior year. Last year, they actually reported income of 166,000. And this year I've got an $80,000 loss. And since we know the rules about loss carrybacks, we know that a P&C company can carry this loss back 2 years. So we're actually going to be able to file an NOL carryback claim to carry the loss back and get a refund of tax. So that's what this 16,000 really represents, is if I carry $80,000 of loss back at a 21% rate, I'm going to get a refund of 16,846. And so when I scroll down here, I'm skipping some stuff, but bear with me. If I come down here and say, well, I have no current tax liability because I'm in a loss. I paid $40,000 in tax, and I've got this carryback claim that I'm going to be able to file and get a refund. So my total receivable is 56,000, and it's made up of the estimated tax payments that I already paid and the receivable that I'm going to get. And so I don't know. This is a hard part to figure out what the next step is, but with most tax revisions, I think that the rule of thumb is if you can figure out your balance sheet accounts, your deferred tax assets, your deferred tax liabilities, your income tax receivable or payable, if you can figure your balance sheet out first, the expense is going to kind of fall out. Like you can then figure out the expense a lot easier. And so that's what we did, with the deferreds. That's what we did up here. We figured out what are our deferred tax assets and liabilities on our balance sheet first to come up with, hey, well, our expense is going to be just the change in the balance sheet account. And then on the current piece, it's okay, let's figure out what my balance sheet number is. And we just figured out, okay, I've got no liability, estimated payments, and I've got a carryback claim. I'm pretty comfortable. This is my balance sheet receivable. And then once you figure that out, you kind of back into I guess you do in a sense back into the expense, because in order for this to be the balance sheet account, your expense needs to be a certain number. But that's kind of what we do over here. It's again kind of hard to, how do you explain it? I guess one thing we always do is we say, well, we know this is what we're pretty sure this is the balance sheet receivable. Now let's look at what was actually recorded. you know, and here's the beginning balances. They had a payable, they accrued some expense, they paid tax. This is what the company had in the trial balance for receivable. We came up with 56,846. And so this number becomes our journal entry. And if this is our journal entry, so essentially what I'm saying is company has 17,000. We're saying, no, it should be 56, which we calculated down here. That means that our expense, and Jason, stop me if I'm wrong, but that means that our expense needs to be this number. Yeah, because if we're gonna debit income tax receivable in order to get from 17 to 56,
Well, you have no other tax expense, current tax expense, right? So yeah,
that would be the credit.
Yeah.
And so then we need to figure out, well, can we explain that? And that's kind of what we do. Did I say 39? What did I say?
That's it.
Well, and there's the rate,
Yeah,
right,
Yes.
I mean, from the.
yeah, that's happening right here. Here's my true ups.
You could have some throughout and- yeah,
Well, I guess I misspoke, right? Because I mean, our current expense is totally different.
Well, but are you looking at, so you're
These
just
are
talking about
deferred, though.
It's gonna be close to that, hopefully.
Yeah, and if it's not, then you have to explain.
If your prior year estimates were a lot off, it could be potentially.
Oh, they already recorded 30. So there's our adjustment. Yeah,
For the total.
yeah. So here's the tie out. There's the 39,766. So
Okay.
so sorry, we're kind of going all over the place, but this is the adjustment we're saying needs to happen to the income tax receivable. And you can see that between these two numbers, you have the same 39,766. Sometimes, the last thing we'll mention, and then we're done. Sometimes you'll find within the tax accounts, some non-tax items have run through there. And so part of what we do when we get this detail is say, okay, let's figure out what's gone through here. If there's anything that doesn't belong, we got to take it out. So in this case, they recorded, hey, I paid $36,000 of tax. Hey, turns out that 1,150 of that was underpayment penalties. It's not truly a tax expense. So we would say, well, we're going to break that out and record this to a penalty account and then the rest to tax. And that's how you get your 39. So, but again, I think the gist of coming up with the current expenses, figure out your balance sheet first. If you figure out your income tax receivable or payable, then you can dive into the expense and see if it's not lining up exactly, then you say, well, what's the reason for that? And sometimes there are reasons for that you reconcile, and that's actually probably what takes us the most time, is trying to reconcile that. But I think, again, the moral of the story is if you get your balance sheet number right, then you're going to figure out your expense. It kind of needs to be what it needs to be.
Yeah.
So yeah.
That's our overview.
Well, it's 11:32.
Yeah.
So
Did we have?
here's the rate rec.
Come in,
Q&A online. Questions here.
Okay.
Well, and I say to Scott's point, the rate rec is pretty dang important as well. Like what Jason said earlier, you say, this is what I'd expect to pay if I had no differences or no true ups or anything. I would pay 21%. But then this schedule says, well, your rate is not 21%. If I add everything up, if I add your total tax expense up and your total pre-tax book income, your rate's 12.3%. Well, how can you reconcile that? And that's what the rate rec does. It says starts at 21 and you try to explain away why your rate's 12.3. The main driver is going to be your permanent differences because those never reverse. And so they hit the rate today and they're not going to adjust in the future, which is why they run through here. So obviously your biggest driver is you got a lot of tax exempt interest. And then true ups will go down here. But that's essentially what the rate rec's trying to do. How do you get from 21% to what your actual rate is? You got to explain that to me. And sometimes there can be some funky stuff that goes through there.
That's important for disclosures. A lot of the
Yeah.
time. Right, that's why It matters because you want to know, but it also matters because you have to disclose it.
Yeah,
The
That'd be,
significant
that'd be
pieces.
your last step is prepare the disclosures.
Yes.
So,
yeah, I guess we
All
didn't,
this stuff.
we put rate rec as your last step, but I guess disclosures,
Yeah.
You
footnotes.
guys have it set up pretty well in your workbook, though, that a lot of that flows
Was,
to the disclosures, right?
Yes.
So you guys help make it
we
easy
look in it and make
through
sure,
your process,
Yeah.
right? So,
yes.
Just to reiterate on slides, we will send those out and post those.
yeah, we
Yes.
we'll send out the slides. We'll also send out your CPE certificate. You'll need to fill that out and keep that on file yourself. If you are participating and wanting CPE, we'll email out the slides and the CPE certificate. We'll also post, after a bit, we will post the recording and the slides on our website as well. So we will get that information sent out, and we appreciate everyone participating with us today.
Yeah, thank you.